Hello, everyone. Today on the final bar, we'll talk about a market just about an hour ago. It took a big downturn and finishing flat for the day. Overall, we're going to focus on wrapping this week, which means connecting today's close with a week ago Friday's close and see how things have evolved. Certainly volatility elevated, certainly lots of stocks moving with stocks making new highs and new lows. Where do we need to be focused? We'll go through the Mindful Investor Live chart list to answer that question together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, reflect on how the trends have evolved, and especially on Friday, really focus on the long-term evolution of trends. You know, the goal of trend following is three questions or three goals you are trying to fulfill. Step one, where are the trends? Step two, follow those trends. And step three, anticipate when those trends may be exhausted or when they may be reversing. So I think we've established the market in an uptrend. We've established that we hopefully have been following that trend up at some point before today. And the question now is, where do you see evidence of a trend potentially reversing? You know, looking at the close of today is the type of thing that feels like there's, the market's a little heavier than lighter, and the fact that it gave up all of the gains from today and finished, just around flat for the day. Looking at the S&P 500, finishing around 3484. And that's coming off of just being above 3,500 about an hour ago. So, you know, this question about whether we are topping, whether we're pushing to new highs, there's no way to predict it perfectly. But what we can do is look at the evidence together and see where the probabilities are aiming. We're going to do that in a few moments. In terms of what's coming up on StockCharts TV next week, on Monday, I'll be moderating a presidential cycle panel. We had a call earlier today with our three panelists, Tom McClellan, Jeff Hirsch from the Almanac Trader, and Bruce Frazier, and had a really good discussion about their experiences and their analytics, their analysis over their careers, breaking down the presidential cycle patterns as four-year pattern, and really focusing on the technical themes going into elections and through year end. I think you're really going to enjoy this discussion. There's three very knowledgeable strategists sort of coming together to talk about an area that I think many should be focused on right about now. On this show, the final bar on Tuesday, we have Jeff Hughes from JWH Investments, and then on Wednesday, the 21st, Todd Campbell from EB Capital Markets in Boston. So it should be a really good week as we continue on here in mid-October. I want to get to our Wrap the Week segment, which is our weekly attempt to make sense of these markets and take a step back a little bit and look at the long-term trends. I did want to start with a survey question that we asked you recently through our polling system. In your opinion, what's the biggest risk for stocks through year-end 2020? Hold on a second. Sorry, little a glitch on the title. This is which sectors are most likely to outperform over the next 3 months. Sorry for that. We gave you four choices: consumer discretionary, materials, technology, and energy. Technology number one with 60% of respondents saying that was the number one sector. That puts us through essentially mid-January through year end. Second place was consumer discretionary. Third place was materials. Fourth place was energy. So for 7% of you, I'm concerned that you thought energy was the best opportunity. You may absolutely be right, but as I've probably mentioned more than once, you know, it's tough to think about the technical attractiveness of energy. If you're looking at energy, it's for something else other than the charts, I think, at this point, unless you're just looking for the biggest mean reversion ever, which again could absolutely happen. 60% of you saying technology, and I think if you look at the long-term performance of tech, certainly no denying it's been in the driver's seat on a relative basis over the long term, and it's a fair question. What's interesting, I didn't include utilities as one of the options, and today, utilities and healthcare number one and number two, with utilities of relative strength really improving. We're going to look at that chart in a little bit, but I was just talking to the students at Babson College yesterday. I lectured virtually for them in the morning a couple times. And we looked at the example of 2009 to 2019. If you look at that 10, 11-year period, 2014 is right in the middle of a cyclical bull market, a secular bull market. And the question is, what's the number one sector performance-wise in 2014? The answer is utilities, which doesn't make a lot of sense. If you think about a cyclical and a secular bull market, you wouldn't think of utilities being being the number one sector, but it absolutely was. So, times like this, regardless of what you think about the market direction, focus on the actual trends, focus on what's working and what isn't working, and that's what's going to serve you well. Just very quickly, S&P finished flat after being relatively strong for most of the day. I was mentally prepared to talk about potential for follow through to the upside. We sort of came off of that thesis in the last hour as the week finished a little weaker than we might have expected. Mid caps and small caps, I actually never really got much in the positive, and the small cap index was down about 0.6%. The VIX back higher above 27 today. In terms of bonds were down a little bit with the dollar essentially flat, and looking at commodities pretty much across the board weaker, with oil certainly driving energy, the sector lower as well. Let's look at our wrap the week chart, which is this one. And this is basically just a quick performance chart looking at the performance of some of the major asset classes since last Friday's close. And if you look here, the S&P is in black. These chopped around a little bit going into the close, but the S&P finishing around 0.1% higher than it finished last Friday. And with the sell-off in crude oil today, they literally finished the week with right about the same. S&P and crude oil right about the same. In terms of what outperformed this week, we had the dollar up 0.6%, bonds up 0.8%, the NASDAQ up 1%, and Bitcoin, the strongest of all of them, up 2%. And that's, I should note, Bitcoin came off a couple of percent today. It had been a strong outperformer up until then. On the downside, gold, the weakest performer, down 1.5% this week. Emerging markets down 0.6%. And small caps down 0.2%. So a couple things strike me here. Number one, not a lot of huge percentage moves. So we've had times where crude oil or Bitcoin or something is really an outlier relative to others. Everything's sort of in this sideways, choppy phase. There's no real clear in the short term, breakouts or breakdowns. I would argue things have kind of come off of extremes. They're now sort of chopping around, sort of wait and see mode. I'm sure some will say this is waiting and seeing until the election, waiting and to see how coronavirus news evolves and, potential economic shutdowns and all those sorts of things. Maybe it's just a, holding pattern until we get more guidance in one way or another. Expectations change. But I would say from a technical perspective, this is reasonable after the kind of moves we've had. Periods of higher volatility tend to be followed by periods of a little lower volatility as you digest. I always call them digestion moves. Kind of have the big move, then you have the digestion period where you process that, and people that bought or sold to get the price to where it is need a little bit of a downtime to figure it out. Other things I would note, the NASDAQ especially, if you look, Monday, Tuesday, Wednesday really was relatively strong, and you can see how it came off a little bit. So sort of this narrowness in performance going into Friday's close here. Let's continue on to the Mindful Investor Live chart. This is where we like to spend as much time as we can. Again, this process that we go through on Friday is part of my weekly routine. It starts on Thursday and finishes on Monday. I would encourage you, hopefully what this does more than anything is just accentuate the validity or the value of doing a regular weekly routine where you look at charts and whatever other information is important to you, and just have a consistent way of reviewing that information. Having said that, let's get to the first chart. So this is looking at the market trend model that I've followed for a number of years. We refer to this pretty regularly, and it looks at the S&P on a weekly chart and tries to address three major time frames: long-term, medium-term, short-term. Long story short, these are all net positive, all sort of long and strong, signifying strength. The long-term signal, buy signal or bullish signal came here in early June and has remained positive since then. The medium-term model turned positive here in early May and has remained positive. It was close to turning a couple weeks ago, and really even at times this week felt like it may do it, but has remained positive. And then the short-term read is simply looking at where the price is relative to the 5-week exponential moving average, just as a proxy for the short-term trend. I really like to use the daily chart for that more than anything, but overall, that's positive as well. So all three for the last couple of weeks have been positive, which is about right. When the market's at or near all-time highs, the trend following model should be consistently positive, and that's where we're at. Looking at the daily chart, so we've now, sort of stalled. I was writing a note to clients yesterday, and I went with the word hesitates as trying to characterize what the market's done. And if you think about it, we sort of came off of the all-time highs here, didn't quite get to 3,600, pulled back to the congestion range that I think makes a ton of sense from a technical perspective, this 3,200 to 3,250 range. We then came right back up above the 50-day, and now we're in that sort of margin of error of previous highs. We're 40 points away from the all-time high, which is about where if the market's going to top out, it certainly would be reasonable to do so, and you could consider that sort of a double topping formation. We broke down through the short-term trend line just using these recent lows yesterday, but closed higher. Today felt like we were going to continue this journey up, but essentially closed flat from where we were. So you had an up day yesterday and then the down day today, and they finished right about at the same level. So that is literally the definition of a sideways trend. We're essentially where we were last Friday after a couple little price swings. So overall, it's been certainly the sort of the pause. And the question, as always, is, do we resume the uptrend? Do we break down? And again, I think this is the time to pay attention to these recent price swings. As long as the highs are getting higher and the lows are getting lower on whatever time frame is important to you, I think that tells you about the trend. Looking at the trend since March, sort of taking a step back, you can see these major price swings of impulse moves and corrective moves overall. Higher highs, higher lows. We have potentially made a lower high, and the question is, I think the thing that really validates that as a distribution pattern is you break below 3,200, which means you have to come off quite a bit. Otherwise, we're sort of in this sort of toppy range. Let's continue on looking at the breadth characteristics. This is one area that certainly rotated from negative to positive very quickly. Here in late September, you can see that all the cumulative advanced decline lines for all of these different buckets of stocks had broken down. They all started to rotate higher. Two of them, the S&P advanced decline line and the mid-cap AD line, have broken to new highs for the year. And you can see I've colored them in green as they've broken out. Two of them, however, have been unable to do so. And the NYSE advanced decline line, the small cap advanced decline line, these are not updated for today's close, Friday's close just yet. By the way, they will here shortly, but overall, based on what I've seen, I'd assume that they'd be relatively flat from yesterday. So overall, you have two of them confirming further upside potential, two of them not quite confirming, and unfortunately, it's the equal weighted version that accentuates the small cap. So essentially, the large mid cap trade is working better than the small cap trade, and that has been the characteristic of the market at times, but it certainly doesn't speak to internal strength with the smaller end of the equity universe. The next chart is looking at new highs and new lows, and talk about a change from last Friday to this Friday. On last Friday's show, we were talking about this increasing number of new highs as more and more stocks were able to make new 52-week highs. At the peak, about 15%, 16% of the S&P on a single day made a new 52-week high. And again, the S&P has not yet made a new 52-week high in the last month. And so, for the market to be propelled higher, usually you have the leaders, the things leading the market higher, that are already triggering the new 52-week high, already getting above their August or September peak. And stocks like Caterpillar come to mind that are still, that are breaking out just fine. And you had an increasing number. And part of what we talked about was to feel better about the ability of the S&P to eclipse 3,600 and to move materially higher. You'd want to see a continued increase in new highs, because that tells you more and more stocks are pushing higher. That's what drags the index up with it. We've not seen that this week. You actually saw a rotation lower. So pretty much everything is in this digestion phase this week. So the difference from last Friday to this Friday is what seemed like, unrelenting optimism has felt more like we've moved up enough. Now we need to take a little break. And the question that's totally reasonable, even if you're long-term bullish, that shouldn't, dissuade you from that thesis necessarily, but it does tell you we're sort of, in a pause before the next move. And my question, as always, is going to be, what's that next move? And I think you look left on the chart to find the recent swing highs and lows to see which way we would break from there. When you look at the breadth conditions in terms of stocks above or below their moving averages, 73% of the S&P above their 200-day moving averages as of yesterday's close on Thursday, which overall is certainly in the bullish category. I don't see that as a negative necessarily, although sometimes the market has topped around those levels. But in an extended bull market, this can go above 75% and even higher and remain there for quite an extended period of time. So I think that on its own doesn't tell you that the market's topping out, but it is certainly a data point telling you we are at the point where either we start to pull back and or may continue to push much further. And so again, it tells you more than ever to pay attention to those support and resistance levels to see what holds or not. In terms of stocks above their 50-day, 70% of the S&P remains above its 50-day, which is more than half, which is relatively constructive. The challenge here is, again, as every time the market's moved higher, you've had less and less stocks going back above their 50-day moving average. That certainly is a bit of a concerning data point relative to some of the others we've talked about. In terms of sentiment, the one we usually use is the AAII survey. We talked about this yesterday, and I would just point out that, if I remember right, but I would point out that it's almost net positive, and it has not been net positive since February, which is actually quite a dramatic turn. Now, usually at a market top, when the market's at new highs, you would see bulls quite outweighing bears, and we have not seen that. In the market peak in 2018, just before that, you had a 45% more bulls than bears, and now we still haven't had bulls outnumber bears yet. In the last 8 months, so it's certainly been an unloved market according to this particular survey. Other sentiment measures, especially the equity put call ratio, with which my guest Mark Newton was talking about on Wednesday this week, overextended. And I think if you look at certain measures of sentiment, that is one. The other one would be the Ridex flows as well, sort of at extremes. Only other thing I wanted to point out was one other chart, the relative performance of semiconductors. So anytime I start thinking about market tops, I look at the relative performance of semiconductors. This group has continued to do very well on a price and on a relative basis. If and when that changes, it just turned down a little bit going into Friday's close. But as long as that overall trend remains positive, it's hard to think about things getting dramatically worse. If that starts to turn, though, you will hear me start to get less constructive very quickly, because that's a bellwether group that tends to do well in a bull market phase. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We're going to do the Final Bar mailbag in just a moment. Wanted to remind you, we love hearing from you, particularly questions that you run into in the normal course of analyzing your markets of choice. Shoot us an email with any questions that you have, and we'd love to answer them on the air. The Final Bar at StockCharts.com is our email. On Twitter, at FinalBarSCTV. You can get us there. And on YouTube, just put a comment below the video and we'll capture those questions. We'll have another mailbag segment at the beginning of next week, and we'd love to answer one of your questions in the next segment. Let's open the Final Bar mailbag. These are all questions we've received from you in the last couple days. We appreciate all the questions you're sending in. We'll get to as many as we can. Question number one. Dave, I came across Coop, C-O-O-P, which is Mr. Cooper Group, from a scan for stocks with a PE less than 10 and EPS, earnings per share, greater than 0. So positive earnings and relatively low valuation. Your question, this is the chart you sent. Thanks for sending a visual aid with your question. The chart was, when I tried to look at the chart sans dividends, without dividends, however, I can see that the unadjusted chart underscore Coop is really unadjusted and that it reflects the historical prices, ignoring both dividends and splits. Is there a way of looking at the chart excluding dividends, but adjusted for the 1-for-12 split that occurred in October 2018? This is the chart that you sent, and just, if you didn't follow the question, you're essentially saying this is the unadjusted chart. If we take the underscore out of it, this is the adjusted data. This is what we would normally show on stock charts, and it shows a continuous data series. If you do underscore Coop, and you can do that before any ticker, it unadjusts the data, meaning it removes the adjustment for splits, for dividends, for anything like that, and shows you the unadjusted data. The problem is this stock got a huge split back here a reverse split back here in 2018. It basically caused the price to go up dramatically. So the rest of the data series is relatively muted. And the problem is to sort of adjust your ability to analyze it. So the short answer is, unfortunately, no. We basically allow you to adjust everything or to adjust nothing. And this came from guidance years and years ago from John Murphy, who obviously has done much to influence how we analyze charts on StockCharts.com. His point was what you should do is adjust data at all points, especially with dividends. And by adjusting the data, you allow the indicators to be more accurate or be a better reflection of the price behavior. What it does is it takes out all the non-behavior, quote unquote, driven adjustments, and it focuses just on the emotional drivers of stock prices. If you don't adjust the data, your technical indicators will be dramatically different. So what we did to try to adjust for that is give you the ability to do either. You can completely adjust the data or completely unadjust it. Your question is, I want to adjust for dividends, but not for anything else. Or I want to adjust for splits and corporate actions, but not for dividends. And that's something that we are absolutely looking at and thinking about how we could adapt it. For now, it is all or nothing. And the way you adjust it is by adding the underscore under the ticker to remove all the adjustments. A lot of times, especially when you're looking at support and resistance levels, ideally you would unadjust the data because that's what the price was actually at a certain point in time. Thanks for that question and that feedback, which we'll add to the development queue for sure. Next question, you mentioned Netflix's underperformance recently. On the weekly chart, there appears to be a most beautiful double bottom according to Bill O'Neill's definition. Your thoughts on an appropriate double bottom having the second trough of the W undercut the first with lagging RSI. So if you're not familiar, this is the chart that you were sort of hinting at. This is the weekly chart of Netflix. And again, thank you for taxing my memory of Bill O'Neill's uses of the term double bottom. Usually we think of double bottom as a broad, big, double bottoming pattern. And in point and figure charting, it's a completely different thing. Well, William O'Neill, who founded Investors Business Daily, he talks about it as more of a short-term thing. It's like a W on the chart. So you have this big run, and then you have this sort of W-like pattern, and that is what he would consider a double bottom. And he particularly, if I remember, it talks about the second one being lower, undercutting the first, the low, as being pretty meaningful. So having said that, no, I have no problem with you calling that a double bottom based on his methodology. But the two things I would say, and I looked again up at some of his rules just to remember some of the specifics. Two things. Number one, the trigger for this pattern is you have to break above the interim high. So until you close above that level around 560, we traded above it this week, but didn't close above it. Until we close above it, the pattern's not engaged. The pattern's not validated. So number one, you have to wait for that. If you're following it, I don't put as much weight on the fact that the RSI has gone down, but I would put weight into the volume. O'Neill's methodology really relies on volume as an input. And he would say the breakout, when you close above there, should have accelerating volume, should have a higher volume than normal. So those are the two things you'd be looking for on the Netflix chart if that's something you are trying to follow. But I think calling that a W bottom at this point, or double bottom, absolutely, according to what he says, is right. I would look for those two triggers to validate it. Next question. I want to thank you for your show, and you're welcome. I have a question on how you set up a chart in today's market wrap video. It was the S&P chart using the name and the RIDEX flows. How do you set it up so that the RIDEX flows were inverted? And thanks for that question. I'm bringing up the chart here. So as always, if you have particular charts that you want from anything I'm showing you, we're more than welcome to them. Just send me an email, thefinalbar@stockcharts.com. Tell me as detailed as you can of what chart you're referring to, and I'll know what it is. And I can send you a permalink, which means you can put it right into your login. You are more than welcome to anything that I show. But here's how I set this one up. This is using I feel like this is an Arthur Hill trick, maybe, when he was showing me how to use the platform a while ago. But basically, this is using the price indicator, and I have the name index as one of those, and then I have the RIDEX index as the second one. But you'll notice the little negative in front of that minus sign inverts the scale, and that's what allows me to put the name index in black going above the zero line, and the RIDEX flows going down from the zero line essentially, and that's what it's doing because I'm inverting the scale. That's a great way to show, because what's interesting is if the RIDEX number is low, that's actually net bullishly positioned, and the same with this. So it's actually aligning the scale. So if both of these are further up on the y-axis, that means they're bullishly positioned, which is contrarian bearish, and if they're both very low, that tells you it's more of a buy signal. So it's a great way to combine different things. Those are tricks that allow you to make these histograms line up in the way that you might want, and I think that's the way you do what you're asking about. Next, you reference the name of an author and his technical analysis textbook that you used when teaching students at Brandeis University. Can you send me this information when you have a moment? Yes, so that book is actually Charlie Kirkpatrick and Julie Dahlquist, Dahlquist, and Kirkpatrick is the first author. Charlie Kirkpatrick actually, did the course at Brandeis before I did. I took it over from him, and that is if there is a college textbook on technical analysis, that's it. And the name of the book is simply Technical Analysis, and it is very well documented. It's articulated, and for years the CMT Association used that book as the text of note for the CMT exam, the professional level technical analysis exam. If you're looking for other books like that, I was going to bring up my website and show you, and then I realized as I was looking, I actually don't have that book as one of my recommended readings, only because it's a meatier book. It's very comprehensive, but it reads more like a college textbook with We Need It. If you go to my website, marketmisbehavior.com, however, and click on reading list, I do have a list of other books for general investing knowledge, for behavioral finance, for technical analysis, and also personal development, mindfulness, all those things. So if you're looking for things to read during the quarantine, check it out. The very we really don't have time for one more question, but I'm going to do it anyways. The question was this: I saw you on Twitter. I own several stocks that are in an uptrend and trading above all of their moving averages. I would like to sell covered calls on them weekly with the intent of either letting the options expire worthless or keeping most of the premium I received. I'm skipping just for the sake of time. The question is, what indicators might help me signal a potential consolidation or pullback? I can't use moving averages as potential resistance because the stock is trading above all the moving averages. So the question is, how do you identify mean reversion, things that are overextended to the upside or from the downside and potentially to mean revert? Two things that come to mind, and again, maybe this is the subject of a deeper discussion we could have at some point. Within our ACP platform, I brought this up. RSI is the indicator that immediately came to mind, and I'm using the 14-bar RSI. But remember, with any of these indicators, you can customize the values. ACP actually allows you to do that dynamically. So I'm bumping it down to like a 9-bar RSI, which is meant to identify really short-term price swings. So this might be the kind of thing that I would toy around with to see when there's an opportunity for a pullback. And again, it's telling you when things have gone up too far too quick and are most likely going to mean revert. The other one is we have an indicator called a distance from moving average. So you could experiment with some of the settings there too. And basically you can actually see how far is a stock from its moving average. And you might find a point for particular stocks that when this stock gets 10% above its 50-day moving average, for example, it tends to mean revert. So those are the two indicators that come to mind that you may want to experience with. Again, ACP gives you a really good way to dynamically change the settings on the fly and start to interpret what those signals might have told you. Thank you so much, everyone, for those questions. Those are thoughtful, and appreciate you sharing some of your journey with us as you try to use technical analysis. We need to wrap the show. Go to 3 and 3. 3 charts, 3 minutes. Here we go. Chart number 1 is the percent of advancers decliners. And this is a chart we've referred to very often. I often look at it to see if there are 90% up days or down days. And this is often a signal of capitulation when investors are piling in on one side of the market or not. What you will notice is in the last week, this has essentially been right around 50%. If I take the average of the last 5 days, I would not be surprised if the average advancers and decliners is literally almost exactly 50%. This shows you the indecision we've been in. This is truly a digestion week, and I think we wait for next week to see which way things break. Having said that, even though the market is digesting sort of in a sideways mode, there are charts that are breaking out and there are charts that are breaking down. In terms of breakouts, I'm looking at something like utilities. Again, this is a sector that's broken above historical price resistance, has now pulled back a little bit, finished strong on Friday with a new 6-month closing high, and the relative strength has rotated from distribution to accumulation. So regardless of what you think about the overall market direction, in general, I want to own stocks that are outperforming or ETFs that are outperforming and not own the ones that are underperforming. Utilities certainly seem to be continuing this pattern of outperformance, potentially worthy of your interest. Finally, within industrials, you have things like Honeywell, Caterpillar, I'm showing you the example here, that are breaking out of bases or really following through on the upside. We talked about how industrials and materials are sort of that second tier of sectors where I think there's plenty of opportunity. The trend in Caterpillar has been really impressive. Overbought right now, and the relative strength making new swing highs. So I think you wait to see, or see there may be potential for pullback, and if it does, pulling back to the 50-day moving average, much like it did there at the end of September, may be a really good opportunity. Folks, that is our show, and that is a wrap for this week on the Final Bar. Appreciate you joining us every weekday after the close to look at the markets through the lens of technical analysis. All of our previous episodes on our YouTube channel. Have a fantastic weekend. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.